Believe it or not, ESG strategies can have a significant tax impact. In fact, typically any strategy that causes disruption to existing business models is going to throw off tax considerations. In this video, myself and John Doran are going to thrash out why ESG is relevant to the world of tax and potentially your business. As you know, ESG stands for environmental, social and governance, which covers the three pillars for measuring the sustainability and ethical impact of a business. Investors and other stakeholders are now measuring the performance of companies not only by financial metrics, but also by reference to these three pillars of ESG. Traditionally, the most dominant pillar of ESG is the E, your environmental strategy. Under this pillar, businesses must assess their impact on the environment and implement initiatives to manage things like climate risk, waste and pollution, and how energy efficient their business and processes are. So how does tax play a role here? Well, we advise businesses on environmental taxes such as solid fuel carbon tax and the new windfall taxes on certain energy generators. We also advise businesses on the tax impact of their decarbonisation strategies. Examples here include advising on the tax impact of investment in energy efficient premises and indirect tax or transfer pricing advice on changes to your supply chains. Post-COVID, we have seen what's known as the rise of the S, the social pillar in ESG. This pillar is all about a company's policies around workforce engagement, human rights and social impact. Businesses are implementing policies around hybrid working, inclusion and diversity in the workplace, and ethical supply chains, and all of these have tax implications. A very topical example of work in this area is gender pay gap reporting. And we're also helping businesses manage the tax impact of hybrid working, which carries huge tax risks due to changing work practices. And lastly, the governance pillar. This is of particular growing importance in the tax world. Here, companies are considering policies around matters like executive remuneration and board diversity. And of course, tax plays an important role here. But another very important component of the governance pillar is tax transparency. Now, John, you're going to talk to us about what is topical here in tax transparency and what we're seeing on the ground in terms of what we're advising clients on.
Yeah, thanks, Paul. We're certainly seeing a greater appetite among certain stakeholders for more tax transparency. To my mind, tax transparency measures fall into two pools. First, we have mandatory tax transparency drivers. So what am I talking about there? It's the likes of the OECD country-by-country reporting, DAC 6 mandatory disclosure, and the forthcoming EU public country-by-country reporting.
What about voluntary measures?
So on the voluntary side, we see certain organisations adopting the likes of the Global Reporting Initiative Standard on Tax, GRI 207. And GRI 207 is essentially whereby organisations opt to disclose certain qualitative and quantitative aspects in relation to their tax policy. In simple terms, tax transparency is really a window through which stakeholders have line of sight into what is happening within an organisation as regards tax. And businesses need to invest time now in assessing what does greater tax transparency mean for them.
So what do you think the first step that a business should take here?
Yeah, I think for me, what I would generally recommend for businesses to do is first and foremost to actually formally document and have a tax policy. And why? Because simply not having a tax policy is a red flag for certain stakeholders. And thereafter, tax functions within businesses, they need to assess how does their tax policy benchmark against best practice and their peers.
And what about the board? So, in a normal organisation, your head of tax will take a role here, but what about board level involvement? How important is that?
Yeah, so absolutely agree. I mean, it's essential that there is board level oversight of a tax policy. And that's important because it gives stakeholders assurance that an organisation is walking the walk as regards their tax policy. And I think the final piece that is also worth organisations devoting some time to is just putting some formality around their tax control framework, just to ensure that nobody circumvents the tax policies that have been agreed and signed off at board level.
That sounds like a lot of work, all formalising tax policies and tax controls.
Yeah, I mean, the reality is that all organisations will have at least some degree of informal tax policies in place. They'll have a certain amount of governance in place, and they'll have a certain tax controls. And really what we're talking about here is just putting some formality and structure around each of those. And the process of doing so will actually better educate organisations in terms of where they currently stand and how they benchmark against peers. And that would prove really useful for organisations as greater tax transparency comes.
Excellent. Okay. Thanks, John. Well, in this video, we hopefully have given you a flavour of how tax is a crucial component of ESG, talked about environmental taxation and the tax implications of changing a business model, and tax risks that are things like hybrid working arrangements, right through to what John was talking about in terms of tax transparency obligations. If you'd like more information on any of these issues, please get in touch with myself or John or your usual KPMG contact. Thanks for watching.